good day. I'm Dean Jones, President and CEO of RealLogic Sotheby's International Realty, and this is Market Perspectives. Today's episode is featuring Kurt Owen, a good friend and a wealth manager with UBS. Kurt, why don't you share with our audience a little bit about your background?
Well, that's a long one. 41 years in the business. I started my first foray into the market even before that in the 1970s, believe it or not, 1973, 74. Great timing. And became a stockbroker in 1983. And since then, as the business has morphed from not just simply trading stocks and bonds, but into actual advice,
right?
From the standpoint of advising on not just the investment portfolios, but the entire net worth of a client. So that's kind of where we are today and what my role at UBS is.
And UBS is a very nostalgic brand. It's been around for a while. It's a little bit like Sotheby's International Realty, and I think we approach our business in a similar way. Give us the backdrop and some of the updates with Credit Suisse.
Yeah, so UBS is the oldest and largest Swiss bank in the world, going back 170, 80 years, something like that. I'm not sure the exact number. And the Swiss banks do have a reputation. We all know that. And, you know, kind of the less said about that, the better. You know, they've got. And you're right. We were already the largest financial advisory money management firm in the world, and then our kind of sister bank, Credit Suisse, stepped on a rake and got in some trouble. And so the Swiss government came to UBS and said, I mean, in effect, hey, we're only known for watches and banks, and we can't have bad banks. So we're going to sweeten the deal so you can buy Credit Suisse. And it was a very good deal. So now we're even larger than we already were, which has real advantages.
Right.
One out of every two billionaires in the world deals in some way, shape, or form with UBS, and there's reasons for that, which, you know, we can cover that later. But that's kind of the background.
Yeah, I mean, I think it's impressive, and there's certainly a brand connotation with that trust and the experience that comes from that kind of horsepower. I mean, certainly the Vatican has chosen the Swiss Guard to watch over their interests.
Oh, yeah, yeah. And UBS is a little bit... the intellectual capital was really, really good there. People want to have that on their resume, or be there. It's kind of like, you know, playing for the Yankees. I'm not a big fan of the Yankees. Sorry if there's any Yankee fans, but you know, if Dean, if you told me, you know, your great uncle played for the Yankees, probably don't know him, don't know his name, never heard of him, but he played for the Yankees.
Right.
Probably is no slouch,
yeah.
Right? And so that's kind of how UBS attracts talent. People want to be there, whether they're there for the long term or for a period of time. So you do have a lot of real good intellectual capital going through the system.
I mean, if I'm going to listen to advice, I would like it to come from a trusted source that has plenty of experience. So, you know, being global and having that pedigree, I think, gives you perfect qualifications to have the conversations. You know, we were just talking a little bit earlier about, boy, is this the roaring 20s? I mean, we're 100 years since the last time we saw a pandemic. Spanish flu was sort of a big deal, and cities went through a revival, and credit was cheap, and then we had a stock market reality. I mean, what sort of consistencies would you say we are here 100 years later, and what's different this go around?
Yeah, I mean, it's always tempting. Like I said earlier, history doesn't necessarily repeat itself, but it rhymes often enough. And I've seen a lot of articles where there'll be an overlay and try to make a point that, wow, you know, we've been here before and this is where we could be going. And I would say that the difference this time around is back then, the banking was done. There was no FDIC.
Right.
There was a Fed, but the Fed was brand new. Didn't really know what its mandate was, and the Fed, in actuality, created a worse situation than was going to be. Right. I mean, Bernanke did exactly the opposite of what, and I forget the head of the Fed at that time was. They did a lot. Let's put it this way: they did a lot of things wrong. So, for example, the stock market crash wasn't what caused the Depression. The stock market crash was what precipitated the failure of banks. And the reason the banks failed is, number one, they had no insurance, no Fed, nobody to back them up. And the other part of it was, back then, margin loans, you could buy $1 million worth of stock for $100,000 of your own money. So do the math on that. If the stock drops 20%, you can just walk away and say, your problem. Well, whose problem is it? It's the bank's problem. And when the market's going up, that's great. Nobody cares. Everything's fine, right? Banks are happy. Everybody's happy. But when you had a good-sized correction, and all of a sudden, and as the market went up, more and more people got more and more bold, took out more and more margin loans. So you had so much leverage in the system. And when the market went down enough that everybody was underwater, they all walked away at the same time, and there's the banks holding it.
Well, and if credit's cheap and you're taking stock tips from the local, shoe shine guy, not to pick on that noble trade, but, the same could be said about, taking housing investment advice during, cheap credit times of the early 2000s.
Yeah.
We've got basically same situation where, there is not a lot of equity or skin in the game, with the cheap credit, and the market corrected, and of course there was a lot of distress in the housing market, and that's what caused the Great Recession.
Oh yeah, I mean, it's all Dean. It always comes down to leverage. I mean, to really create a problem in the system, I mean a dangerous one, not your typical market decline and your normal market cycles and things like that. But to have a real problem in the system, you've got to have excess leverage where people get into trouble, where you actually have failures. And, that exactly what happened in the great financial crisis. You had all those, mortgages, and you had, people who owned multiple homes that, couldn't carry them, right?
Yeah.
And it just kept building on itself, and then it all collapsed.
Right. Well, and speaking of cycles, I had this little fun exercise I wanted to try with you here, Kurt. Let's go on a journey.
Okay, let's do that.
So right after the Great Depression, there was The Wizard of Oz. You know the movie, and it was in black and white. Came back in Technicolor.
Yeah.
But I was thinking about it, and it could be a bit of a journey we could take our audience on today. So speaking of tornadoes and historic events that occur over a lifetime. And let's take Dorothy as a character and suggest that might be your client, your stereotypical client. I mean, you've been around for a little while and you've seen a few tornadoes. I mean, what are we sort of in right now in your mind? I mean, are we coming down for a landing over the rainbow right now, or are we still in a tornado?
That's a good one. You can make really good arguments for a soft landing or a hard landing. And it looks, I mean, the people that I talk to, and that's their job to be smarter than me, and thank God they are, build a pretty good case that we'll probably have a soft landing.
Okay.
I think the Fed has done I mean, they were late, right? But at least they weren't early, unwinding things. And so they're going to be cautious the way they unwind interest rates and things like that, and that's probably a good thing. We're blessed, I think, with technology which creates efficiency.
Mm-hmm.
And so for that reason, there's a lot of... I mean, look what's going on with AI. Have you used that?
Microsoft's enjoyed that stock ride, haven't they?
Yeah, Copilot and ChatGPT. And, we're just that far into it.
Right.
And so I think the productivity and whatnot, I mean, I hate to like hang everything on one thing like that. That's always a dangerous thing to do. But at the same time, you can't ignore it. It's a big deal.
Well, I mean, I think the whole tech revival, what was $1.5 trillion in equity gains have been returned in the last year to tech stock. And that's a big deal for us in the Pacific Northwest. Sure. So, I mean, let's just say, back to our analogy, and, if our journey is to get to the Emerald City, which we're happening to be in, that is a life better lived. I mean, really, that's your goal as a wealth manager and a financial advisor is over a lifetime, right, of comments. And I kind of look at that yellow brick road like bricks in your future, and you can be steered off the path by some bad advice, or you could follow the right course and eventually get to your destination. So as we kind of play along with that idea, and perhaps the yellow brick road is also the guardrails that you might provide, to keep your client on path. I mean, walk us through how you interact with your customer and the kind of relationship you have, because as you were saying, it's not just about stock picks.
Right. The really the biggest thing, and it's the failure that happens mostly, is it's all about planning. I mean, that starts and finishes with planning. I always tell, the clients that I work with, and same with clients that you work with, when you have a significant amount of wealth, and these are the people that we work with, along with that wealth comes complexity, comes stress, comes uncertainty. It's just the way it is. You got that kind of money, you're going to have multiple pieces of real estate. You might have a business or two. You might have a boat, a plane, or both. You might have a family or more than one family. So, college, and there's all these obligations. And the talent that got you that money isn't the same talent that's going to allow you to manage this circus you have now, right?
That's right.
I mean, it's huge. And I think that's where a lot of people are. What our value proposition, my team, is, Dean, you have 1,440 minutes in every single day. You don't get a minute more or less. Same with me. And inside of those minutes, we all do things that we probably shouldn't be doing. Not the highest, best use of our time. Okay. And in the world of finance, there's plenty of that. Our job is to leverage your time, leverage your talent, because that's how you got the money in the first place. You didn't get it by accident. Simplify your life and give you confidence in the decisions that you have to make going forward. And I really think that that's the same, that's what a good Sotheby's professional should also be doing. And that comes down to planning, because that's where the simplicity comes from. Doing the planning creates a simplicity, creates time, which is the biggest factor. The only limiting factor to your talent is time. You can be the greatest artist in the world, but if you never get to sit down in front of an easel, who cares? It doesn't matter. So what we do is we create the time by doing the planning, creating the simplicity, taking those burdens off of, in your case, off of you, so you have more time to do what you want to do, what you're good at, and bring other people to the party to do the things. I mean, I don't do my own taxes. I could. I'm not stupid. I'd rather have my teeth pulled, right? So well, you hire somebody else to do your taxes,
right?
And that frees you up to spend time, with your family or your hobbies or your career, whatever. So that's really it's all about planning. So to answer your question about what is it for Dorothy, right? That we would do is like, okay, Dorothy, where are you right now? Okay, well the tornado hit and you're sitting here and you're trying to get to the Emerald City. Okay, got it. At least I can get you there, but I have to know where you are.
Yeah, and where are you in that journey of life, and what sort of trials and tribulations? I mean, I think of those bad apples in the orchard being thrown at Dorothy along the way, or the Wicked Witch. Things that perhaps are economic. They could be tax policy. They could be government intervention. What are sort of those flying monkeys that we should be looking out for right now? If you're Dorothy trying to get to this beautiful future, a life better lived, but you better be on the lookout for those fireballs.
Absolutely, and kind of understand how the game is played, what's going on out there in the big picture, and for me, I'm lucky because I don't have to focus on anything but that. Right. So for me, a lot of that is obvious. I understand government policy, I understand how it works, I understand most of the time it's wrong. Good intentions, bad outcomes. I think, and we were talking about this earlier, but in the world of real estate, the migration patterns that are happening, you're seeing migrations of people from high tax, Connecticut, California, Illinois, New Jersey, New York. And it's big.
Right.
It's shocking how big it is. And going to places like Texas, like Florida, what's some of the other ones, Nevada, Arizona, even Washington. So Washington still has some allure.
Yeah, we're the evergreen state,
exactly.
Right?
And we don't have a state income tax.
Yeah,
it was still. I mean, well, they're trying to screw that up. And so I think that's a really important thing to keep an eye on, because if we keep our secret sauce and keep ourselves as a state that has a lot of economic activity, it's a low tax state, it's not prohibitive for somebody with high wealth to be here, right? Like California.
Right.
A lot of Californians are coming to Seattle because they're used to tech. We've got tech. There's no income tax here. There's an income tax there. So that's pretty attractive. Now, at the same time, you had, a pretty wealthy individual we all know is named Jeff, our buddy Jeff, who made quite a stir by saying, I'm out of here.
Back to Florida.
I'm going
to
Florida.
Tax state.
Yeah, low tax. And part of that was the capital gains tax that the state of Washington
That's right.
implemented.
7% on those stock gains.
And I deal with that. I've got clients all the time talking about how do we deal with this. And, at the end of the day, if the state, and this is going on to an initiative so that everybody can vote on it, and hopefully it gets repealed, because it's basically telling kind of the people who pay for a lot of the stuff, who generate a huge amount. I mean, think about the money that, I don't know what his lifestyle is, how much he spends a year, but just think of the state sales tax you pay when you buy a jet and a boat and, all the other stuff that a guy like him is buying.
Right.
And if he's gone, well, that tax is gone, but the spending still remains. And so I think that the repeal of that, the idea is that we're going to collect all this tax. Well, you collect it in the beginning, but you'll lose it in the long run because he's gone. So I think from the standpoint of real estate, circling back to that, keeping an eye on the silver tsunami, right?
Aging demographics,
downsizing for all the right reasons. Also, that goes along with that, which is very important, is 60 to 63% of all the privately held businesses in the country are owned by baby boomers. So if you do the math on that, there's going to be a lot of businesses that are going to change hands through sale, death, whatever. But it's going to happen. It puts a lot of money in play, and a lot of these people are going to look for ways to avoid the taxes. So again, if the state were smart, you'd be a haven.
That's right.
Like Florida, Texas, and that would attract money. And I hope they don't continue down this path to repel and because it's so easy. I've got a lot of clients already. They're in Arizona right now.
Well, I mean, California has, I believe, a net loss of residents. The Golden State's hard to keep the gold, right?
Yeah.
And I think I read somewhere that one of the greatest migrations is from California to Texas. There's about 1,250 people a week making that migration. So that's a loss for California and a great gain, especially for real estate and taxation in Texas. They say Texas, not taxes.
Yeah.
But in the United States, there's winners and losers, and I think we're probably more on the winner game.
We are
for now.
Unless
this repeal doesn't play out, and no government has ever met a tax they hadn't enjoyed increasing, right? So a lot of people are worried that that's just a gateway elixir for an eventual income tax in the state that is constitutionally not supposed to have one. Right. So learning from you, the signatures are on the ballot for this repeal, and maybe we'll go away with this 7% capital gains tax. It does not include real estate, so be
thank
clear.
God for that. Yeah.
But
there's certain exemptions, but it's.
But the indirect impact is there, because if you're a millennial tech worker in an apartment and you have restricted stock units and your net worth is really not in real estate yet, but it is in tech stock, let's pick on Amazon or Microsoft, and it's going to cost you 7%, with the gain over, is it 250,000?
Over 250, yeah.
So that could impact whether or not you sell the stock. If you think your property value is going to rise quicker than your tech stock, then you might want to divest from a stock portfolio into real estate. But that hasn't happened yet.
No.
So I look at those apartment towers as incubating our future homeowners, and many of them are probably watching that capital gains tax pretty closely. And some of us are getting in our plane, if you have one, and you're off to another market like Florida. Mr. Bezos famously made that move, and I have to imagine that includes him thinking about selling some stock.
Well, absolutely, because you sit there, and like I went through this exercise with one of my clients, and the tax of selling their stock pretty much paid for their place in Arizona.
Yeah.
It's like, well, it's a no-brainer.
Yeah.
And, spending 6 months in a day in Arizona isn't so hard to do in the wintertime.
Right.
And so you just multiply that out, and they all talk, right? I mean, you go down to Arizona, and I've got a client down, a number of them, and you go down there, and it's like a suburb of the Pacific Northwest down there.
It truly is, and we joke in real estate often here that Seattle is a great place to live and a good place to leave, especially during the winter months.
Yeah.
As long as you don't step over that line and end up with a new tax situation in the state of California, for instance.
Yeah.
And so let's go back to the Wizard of Oz. I think of the Tin Man, and I think of the oil can and the increasing of flexibility and being able to make moves, once you have removed that kind of friction, whether it's taxation or just not having, the knowledge or the courage, thinking of some of the other characters, to step forward and take that advice. And they could make some pretty big mistakes. They could be led down the wrong path and end up in the wrong location further from the Emerald City. I mean, can you think of some examples of your clients that might want to actually take the advice prior to selling a company or planning for their retirement, and because they didn't make the right moves at the right time, they ended up with a fairly hefty tax bill?
Well, knock on wood, I don't have clients that have.
Because they're listening to you.
That's the whole point, and it doesn't make sense for them to do something and then ask later. But that happens most situations, happens all the time, and the beauty of having, like I was talking about, the planning and doing the financial plan. The financial plan doesn't just sit on my desk, and it doesn't just sit on the client's cupboard someplace. The financial plan is continually updated because markets change, dynamics in the family change. Marriages, deaths, divorces, whatever. But all those things happen, so it's a living, breathing document. But the biggest key about that is that plan doesn't stay just with us. It goes to the CPA, the estate planning attorney, the business attorney, insurance people, the lenders. Everybody gets to see it. And for the first time, everybody goes, oh, I can see now because this is all about seeing into the future. That's what planning's all about.
Yeah.
The financial plan is going to say, this is how this person's going to look probably in 3, 5, 10, based on where we are right now. And so now the tax attorney or the CPA can do tax planning that was never able to be, it was all reactive before.
Right.
Now they can react in front of it. If you were going to make a transaction, buy a building, a business, whatever, a house, you talk to, first person you talk to is me. Hey, Kurt, I'm thinking about doing this. Okay, well, you go back to doing what you're going to do, your business, skiing, whatever you're doing. I'm going to call your CPA. I'm going to call your attorney. Let's just see what we think. How do we want to structure that? How do you feel about debt? What's the interest rates? They go off and do what they're doing. I'm in the background doing all the other stuff. Come back and say, hey, here's what the CPA says. The best way to structure this is what the attorney thinks. We're going to have to make some adjustments in your estate plan if you're going to buy this, and blah blah blah. All this other. The client would never do that on their own. They would never figure all that stuff out. And they're reluctant to call the CPA or the attorney because that's going to cost money. And half the time they don't understand the language they speak anyway, right?
Yeah.
And they don't want to sit there and go, $500, $600, $700 an hour, go, what was that again? Even though they can afford it, they just don't want to look dumb.
I mean, they can't afford not to have that. I mean, I think of
we
now
do all that for 'em.
The scarecrow that, wanted to have a brain, wanted to have the smarts to make the right moves to advise Dorothy along the way, or the lion that needed to have the courage to do the same thing. And we already mentioned the Tin Man with the oil can, which is to, reduce friction, increase flow, and have that little celebration.
But the last person I didn't mention is the realtor.
Yeah.
We're
on the team.
Too.
We're on
Absolutely.
the team.
You want to be able to see this picture so that you can talk intelligently about what type of real estate this individual is going to buy, should buy, terms, how it should be done, and where. And without this, you're kind of in the dark. And to be able to connect up with the CPA, the attorney, and everything. Okay, now that they're going to buy it, what's the best way to buy it?
And let's go back to this silver tsunami and the idea that there is incredible amount of equity in single-family homes that are probably including many bedrooms that haven't been used in a long while.
Yep.
And these folks are likely to downsize. They're empty nesters, retirees, looking at the sunset of life, right? Probably looking to buy a second home or third home in a sunshine destination, or set up an annuity, for their children and try to not get abused with capital gains taxes.
To think about.
Do you think knowing that we'll have a new president, there'll be new legislation, with some of the current capital gains tax benefits that we have that could sunset at the end of 25. What is the likelihood that a capital gains tax might increase, and thereby those folks that are sitting on millions of dollars of equity in their single family home that they are going to sell, they might be more motivated to do that in the relatively near future while capital gains taxes are lighter.
Yeah, and that is a big concern. I mean, 2025 is a big deal. It's going to depend on what Congress and the president, the White House looks like.
Well, what is the issue? Help our audience understand what you might not realize we're enjoying right now that is not a forever promise in terms of the capital gains tax.
Yeah, I mean, right now the capital gains tax, the top capital gains tax is 20%, and then you add the Obamacare on top of it, so you're looking just under 24%. There's been talk that they would just allow the capital gains tax to float to your ordinary income tax rate. So then you could be sitting up above 40%.
Ouch, that's a big delta between 24 and 40.
It's huge. And the whole reason capital gains tax treatment is what it is, meaning a lower tax rate, was to encourage investment, risk investment, because that's what capital gain is. If you invest in a CD, you get ordinary income. There's theoretically no risk. If you invest in Amazon or Microsoft or the next new startup or whatever it happens to be, that's risk. That comes out as a capital gain. And so you're rewarded with less tax due upon gain for investing in something that's going to grow the economy, that's going to create growth, that's going to create innovation. So it's in the tax code, and that's the reason it's in the tax code. Will the politicians with their infinite brilliance decide that should go away? I really hope not. I mean, I think that there's a tendency to go, oh, the Democrats are really bad when it comes to taxes, but they haven't done it historically. They haven't. Even they understand that capital gains is really important for capital formation. So I don't think the capital gains. It could get worse, but I don't think it's going to go to the same level as ordinary income.
Yeah, I mean, certainly we look at other countries, including Canada, my home country, and it's not a cheap place to be, for taxation. Yeah. And it certainly hasn't lightened up at all. So I think overall the economic opportunities in the United States and the entire capital stack of taxation is not too much of an imposition compared to the lifestyle that it rewards you, and I think that's why we're here. Right. But even from state to state, going back to your note about migration, exactly. And also as you do age, I mean, let's be honest with probate in Washington State, not a great place to pass.
No, Washington State does have a estate tax, and it starts at a very low valuation. It starts at 2.3 something. Call it 2.3. So anything over that starts off at 10%, goes up to 20%. A lot of people don't know that. They focus on the federal income tax because that's kind of the big one. But you don't hit federal income tax if you're married. You don't hit federal income tax till around 20. I guess right around round numbers 24 million. Then once you're above that, then you've got some planning that you really have to do. Right. Most planning should be before that, but. So that's where a lot of people, and so they forget about this nasty little Washington estate tax, which is why people tend to move to places that don't have an estate tax.
I mean, it's such a critical thing. I mean, there is a lot of wealthy individuals that are in our collective portfolio that they are aging on in life and they are downsizing, but they're also relocating for that very reason. Back to our analogy with the Wizard of Oz, you don't want to step on Toto, right? You want to take care of your family. And if you're going to not plan appropriately and you're in that tax bracket, you could have a very sizable bill that does not protect that family wealth, if you will, that generational wealth. I mean, let's talk about how big of a number it is. In the balance of this decade, which could certainly be the roaring 20s yet again for the transition of family wealth, generational wealth transfer. I mean, it's a big number.
It's trillions.
Trillions of dollars.
Real estate, businesses, financial assets across the board.
And a lot of folks, like I know my parents who are definitely downsized from a larger single family home to a condominium, single level. They spend half their time in the desert. They're unwinding assets, basically preparing for that event, wealth management and also transfer of wealth. And taxation definitely is a big part of that consideration. And the fiduciary duty that a wealth manager or an executor plays in that sort of series of life events. When you think about capital gains tax, again, I mean, what in the United States are some other tax deferral strategies for people that might have amassed a portfolio of commercial real estate, for instance, and they're an active participant, changing light bulbs, leasing out units, fixing water damage, when they really want to be on a boat somewhere around the world with their spouse, but they can't because they are an active participant in their real estate portfolio as a landlord. How might that individual that also might want to sell out of larger single family homes look at that portfolio and get into a tax deferral strategy that, maybe like a Delaware statutory trust, maybe share with our audience how that mechanism works and, why that's better to get into a passive real estate investment instead of an active one without triggering tax.
So there's a number of funds out there where, and you can call them exchange funds, you can call them all sorts of things, but basically it's a 1031 exchange, and you're essentially, and we all know how that part works, right? Except in this case, you're exchanging into a fund. You're not actually exchanging into another building, property, whatever that you still have to manage. You're exchanging into a fund that's going to be managed by somebody else. And those are out there, and that's got some attractiveness to it. For exactly the person you're mentioning is like, wow, I don't want to pay the tax. I don't want to manage this anymore. I want to be on my boat. I want to be in my place in France. I want to be whatever you want to be. And so that would be a solution to that.
And I think you can also set up, like if you have a Delaware statutory trust, or DST as they're known, you can also grant those to your children without taxable events as well, right? So it's another way to unwind a portfolio of strip malls and hotels and rental properties. I mean, just things that require a lot of attention and maybe your specialization. And I think the audience would be surprised to know how many commercial developments and, restaurant chains and, small businesses, gas stations, funeral homes, I mean, things that are owned by wealthy individuals and not by large REITs or large corporations.
It is surprising. People don't realize that, but you're absolutely.
I mean, is it a quarter? Is it a third of the commercial assets out there, for instance, to pick on one product line?
Oh, I think it's even more than a third.
So that's a pretty big volume of uncoupling from those real estate assets, right? And not triggering taxation, but then also not trying to hand those keys over to, the next of kin, in that situation.
And again, it comes back to the planning on that, because you don't want to do it under duress.
For sure.
And I always tell people, you can always do the planning and be ready. You don't have to pull the trigger, but being ready is better than not being ready when the economics changes, or there's a death or a divorce or a disagreement or
a pandemic,
right?
Stock market imposition. I mean, there could be any number. I mean, global political, geopolitical concerns that are affecting things beyond your control.
Exactly.
I mean, these are the flying monkeys around us, right? I mean, these are the fireballs being tossed into your planning. And it's a little better to have some forethought on that and know what you would do in this event, as opposed to going through the emotional issues.
It doesn't happen, and you're great. But if it does happen, you're like, okay, well, at least I saw that coming. It's not going to be fun.
Right.
It's going to be painful, but it's going to be way better than you're being totally blindsided by it.
Absolutely.
And that's, really the job of you and your team for your clients to talk about these sort of things and be aware that, things can happen and give good advice. It's all about advice.
I just had this image of our Dorothy lying in the poppy field, drifting off to sleep, and time passing by when all this other activity's happening, and being sort of oblivious or unaware that you need to get back up and get on your journey, and eventually you're going to reach the Emerald City.
Yeah.
And hopefully with as many dollars in your pocket. And I'm remembering now a comment my father had made to me. It's the journey of wealth management is you need to make the money, you need to collect the money, and then you need to keep it, either from other liabilities or taxation or hedging from potential, conflicts or challenges or government that could grab it, and I guess that's part of the journey that you're on with our Dorothy, if you will.
Yeah, I mean, there's always somebody or something out there trying to separate you from your money,
right?
Unless you don't have money, and then you don't have to worry about it.
Well, and now I have in my head, all those little munchkins that are telling you to go this way or that way, and you can end up taking advice from the wrong person, your Auntie M in this analogy, who you're faithfully following, but just because they're your parent or a loved one doesn't mean that they are the best prepared to tell you what to do with your investments.
Oh, man, I could tell you so many stories about that. But yeah, you're right. Everybody's got an idea. It's funny. Everybody can tell you what to do with their money. And I've had that happen with clients. And my brother-in-law says, do this.
Or the stock tip.
And of course, you get the brother-in-law on the phone. And this actually happened one time. He said, well, you should be doing this. I said, well, let's open an account. We'll do it. With your money.
Right.
Oh, no. It's like, you're not really that convinced, though. You get somebody else's money is fine, but you won't do it with your money.
Yeah.
And that's kind of where the rubber hits the road. And so at the end of the day, I'm accountable for, what my clients do based on what I suggested and guided them to do. And so somebody else can give you advice all day long, and they're not accountable for it. They just like to hear themselves talk. We all like to hear ourselves talk. Come on, right? And so for Dorothy, she has to be able to sort that out as to what's just talk,
right,
and what's real advice.
I mean, she doesn't want to have a house land on her,
no,
right? So, how do you earn and maintain that relationship? I mean, it sounds like your clients are in it for life with you.
Oh, yeah. Well, because when you go through the process that I already described, and you've done the planning, you've created all this time, they have their life back, which they didn't have before. They had a life, but it wasn't like the one they have now. Because now they have all this time, and they sleep at night. They're not worried about their estate plan. We've got the handle. They're not worried about when they're going to sell their business or how they're going to sell their business. We've already got people talking about that, and whenever they're ready, we've got all that stuff handled. So it's just a whole lot easier for them just to enjoy their lives and go forward, right?
Which is what you should be doing, in the sunset of life, or even in the, the busiest years of wealth creation, is that balance, and I think some of us can be, lost and lose perspective about tax planning or about making other investments and not putting all your eggs in one basket. And diversification, I would say, whether it's real estate portfolios or stock portfolios, what other sort of investment widgets are you a fan of for folks that might want to have some safe harbor out there?
Diversification is the key thing. The old saying, concentrated investments make you rich, diversified investments keep you rich. And so it kind of, you can take more risks, obviously, when you're young because you have more time on your side and et cetera, less obligations and things like that. So we're constantly looking at everybody's different. So we're constantly looking at the portfolio and what's appropriate for the individual. But at the same time, there's really good investments out there. There's bad investments, but there's really good investments out there. It's not really hard to find them. The real secret sauce is really the asset allocation and the rebalancing, because markets go up, markets go down, right? When a market's up, what should you be thinking about? What's the next thing? Well, it's going to go down. It always does. I mean, markets don't just go up forever. It's kind of like, if it's, summertime, fall's going to happen. Okay, you got to get the sweaters out. You don't have to get them out now, but probably should think about where they are.
Right.
You're going to need them.
Right.
And you're going to need the raincoat. So we're always thinking about, like, if you're in a bull market right now, let's start preparing for the next thing, which is going to be a bear market. Not that we're looking forward to it, not that we want it, but we know it's sooner or later going to show up. So we manage the portfolios to be able to, when the bear market happens, it's not like, oh my God, didn't see that coming. So we start taking some chips off of the table. And there's plenty of places where you can take chips off of the table. You're supposed to do that anyway, right? Nobody does it, but you're supposed to do that anyway. Take some chips off of the table, put it in some safe investments, whether it's, for a while there, REITs were the place to be, like any of the non-traded REITs, which held up better than other things.
Mm-hmm.
So you could be in places like that where your money is more or less not exposed to an expensive part of the market. Let's just put it that way.
Right.
And then when the market comes down, and ultimately it will be, it's kind of like going to Nordstrom during a sale. I mean, that's the time to go. I mean, you don't want to go to Nordstrom not during a sale, and then 2 weeks later there's a sale. Go.
Well, I'm reminded also, I mean, when everybody is buying is when you sell, and when everybody's selling is when you buy, and supply and demand, it's a
and
fairly
well
well
understood.
understood.
So you never know for sure, but you have a sense that, this is not the bottom of a market. I mean, the S&P just hit a record high. Does that sound like the bottom of a market to you? No. I mean, so, maybe you can take some chips off.
I mean, maybe that's a little frothy, but, everyone tries to...
can't keep going.
But everyone tries to find the peak, right?
Sure.
Or everyone's trying to time the bottom, and it's a little difficult to do. And, I think in your business, you're following the trend lines and not the headlines.
Exactly.
I mean, by the time it hits the Wall Street Journal,
everybody knows it.
Everybody knows it,
Yeah.
and you probably missed the moment.
Yeah. It's really more about anticipation, and we've talked in the past about statistics and how statistics can be really helpful, telling you, is this likely? I mean, and they don't, like I said, they don't ring a bell at the top. But one thing I tell you that's actually really interesting, tops are made on good news getting better. Bottoms are made on bad news getting worse. And people always forget that. But you can take any market, whether it's gold or oil or the real estate. Think of the real estate market. Remember where the top was in 2007?
Yes.
And the news couldn't be better.
Yes.
I mean, God ain't making more real estate. And everybody, the numbers were good, everything. That was your top. And then what was the bottom? The exact opposite. Jingle keys, where you're just throwing your keys at the bank.
But I think we lost sight of the fundamentals, which is that there was very little equity, in those real estate portfolios, and those that could fog a mirror could get a mortgage, and then, created a flood of demand in the market that was never going to be sustainable. So I think doing the homework and looking at logic, I mean, what you can't plan for, and let's be fair, in real estate, this gold rush of cheap credit and what happened during the pandemic, I mean, we went from a very deep frown to a very large smile, back to a deep frown, in a course of basically 4 years. Yeah. I mean, that is a yo-yo that is confusing, and I don't know that we have any history to look at that.
Like that, is there? I don't.
I mean, it feels a little bit like the Great Recession. I mean, obviously we had the reasons were different. I mean, we had a gold rush of transactions. We had a boon of development, and basically we misread the real true demand that was going to be sustained.
Well, and I guess the two things in common was the flood of money. The flood of money in the first one was because of credit. The flood of money in the second one is from the government.
Yes.
Just pushing a lot of
stimulant.
Money. Yeah, stimulus. So
and frankly, it gave us the thought that maybe we weren't going to work in an office tower, and we could live and work differently, and so where we choose to live and how we choose to live became a very unique segment of the market. And but you've faithfully been going into your office tower. You live in Magnolia and a faithful Seattleite, and you are working downtown Seattle
pretty much every single day.
How busy are your escalators, elevators, and hallways?
It's actually changed quite a bit, and the reason I did that was I'm one of those people that if I try to work from home, next thing I know I'm taking the garbage out and cleaning the dishes or something like that. I get sidetracked, and because it's my home. So, and the kids were out of school and being homeschooled, I got to get out of here. But the other reason really was my clients depend on me to kind of be their eyes and ears. And so that I could tell them I'm downtown every day. I walk a lot. I see Seattle like probably a lot of people don't see. And I've worked in the city since the mid 70s. So I think I have a perspective that a lot of people don't have because I've been here so long, and I mean in the city. So I have a pretty good sense that I can share with my clients of what's going on. And I'm a photographer, so I take a lot of photographs of, what was going on. This is history.
Yeah, the good, the bad, and the ugly
at
times.
The good, the bad, and the ugly. And I've been taking photographs downtown since I started working downtown. So I've got a pretty good body of work. So I think it's depressing, but at the same time, it's still fascinating. Like during the Great, I could go on and on about the Great Recession. What I would do is I would walk from Freeway Park, which is where I park my car, and I'd walk through the Olympic Hotel. I'd cut through the Olympic Hotel and walk through the Hotel W. I'd cut across 4th Avenue, because my office is on 4th and Madison, and I'd walk through the Hotel Monaco and go to my office. Why would I do that? I wanted to see who's in the hotel.
I thought you were hitting all the bars.
Yeah, I probably should have been. Believe me, there was times I wish I was, and I needed it. But what I was trying to do is gauge what the economic activity, because that's a good way to gauge.
It's fascinating.
Hotels. Yeah,
I mean, it's like talking to the Uber driver or
exactly.
People
that, I did that too.
Or looking at migration trends by talking to moving companies. I mean, that's where some of the data points come from.
Yeah.
And again, back to those trend lines instead of the headlines. And so, I mean, it's interesting analysis that you have. I mean, where do you feel we are at as a Seattleite with a new administration, city council, and are we in recovery? Are we going to make it through this storm that we've been through the last 4 or 5 years?
Yeah, I think we're in recovery. Yeah, and I can see it. I mean, in fact, I walked from my office to, I'll plug one of my favorite restaurants, the Pink Door. I walked to the Pink Door yesterday for lunch, and I could walk down 2nd or 1st, but no, I walked through the belly of the beast 3rd because I just want to see what it looks like.
Right.
And it's still bad, but boy, it used to be the west side of 3rd Avenue was pallets and tents, and you literally would have to walk in the street to walk from, let's say Union to Pike. It was that bad. It's much more cleaned up now. So, and I know Bruce from the WAC, and I know he's got a lot on his plate. We talked to him a couple times. Our mayor, yeah. And he's a smart guy. He's doing the right thing. He's got a business mind. He gets it. The city council has changed over quite a bit from where it was, and the policies are changing there. I think that there's still a lot of boarded up glass downtown, a lot of it.
Don't take it for granted. These cities have survived a lot.
Sure.
Going back to our, the last time we had a pandemic, and cities got crushed. 100 years ago.
Yeah.
And there was a social revival. People do want to come back together. I think the purpose of the office building may be different than it was pre-pandemic, but the livelihood and the economic vitality. I mean, that's what our cities are and will continue to be. So I'm glad to hear you're a confident city dweller.
You can see that it's getting better. I mean, it's never going to happen as fast as we want it to. Let's face it. But it's going in the right direction, and you're going to see more and more of those boarded up windows. Those boards are going to come down, and businesses are going to be in there. It's going to take a while, but it's going to happen.
What's keeping you up at night right now?
What's keeping me up right now? Geopolitics bothers me.
There's a lot going on.
A lot going on there, because that could go sideways in a real hurry.
I mean, aren't we witness to that right now? I mean, we've got potentially 2.5 wars going on.
Yeah, and it could get worse. That's what keeps me up at night, because that could throw everything, all your plan. I mean, and like I say, do you plan for that? Yeah, in the back of your head. I mean, you don't go 100% in. Otherwise, you just sell everything.
I mean, Gulf War, and let's hope we don't see any of this history repeating itself with current tensions. But what happens in the economy during or post an event like that? I mean, take us back to the last couple of times that we've been in that region, and what happened with the stock market, what happened with bank rate, mortgage rates, and overall economic conditions.
V-shaped in general.
Okay.
There's all of a sudden you trashed the worldview and all your plans, so your initial reaction is sell. So that happens. And then everybody takes a step back and looks and goes, okay, well, the world didn't come to an end. Things are different. And, unfortunately, wars generate revenue. I mean, and you can go back and have, listen to what Ike Eisenhower said about the military-industrial complex. It is what it is. It's not a political statement. It is what it is.
Yeah.
You don't have to like it, but there's money that gets spent. Things readjust. Innovation happens out of war. Some of the greatest innovations. I'm not an advocate of war, but
no,
some of the greatest innovations came out of wartime when you've got a gun to your head and you have to figure out stuff quick. So technology and everything. So yeah, I hope that cooler heads prevail and nobody. War is only going to happen if somebody thinks they can win, right? Otherwise, why would you bother going to war? And so hopefully we can keep everybody with cool heads so that nobody thinks that they're gonna I mean, and winning means you don't go in thinking maybe we'll win. You have to be pretty confident you'll win to do something like a war. And so hopefully it's not obvious to any side. I mean, I'm talking the superpowers here. I'm not talking about what's happening in Gaza, because that's already happening. So yeah, but that's the thing that keeps me up at night.
Yeah, I mean, it's certainly concerning, and we have our own, political challenges. We've got an election coming up, and we won't be able to call this one as a pick, but where do you think the Fed's going to be doing this year? Knowing that we've been through quite a bit, I personally feel like they used a sledgehammer instead of a scalpel dealing with the Fed fund rate and of course mortgage interest rates over these last couple of years.
Yeah.
Any bets on where we might be by the end of this year, post-election, post-pandemic, and post-Fed abuses?
Yeah. Well, the sledgehammer, you're right, and they did that because they got behind the curve.
Okay.
And they should have reacted in front of it. It's always about being in front of the wave, not behind it. And in an election year, the Fed is kind of handicapped as far as not being able to do much, and probably that's a good thing, because if let's say they cut rates, well then you're messing with the election. You're trying to help the incumbent. Let's say you raise rates. Oh, now you're trying to hurt the incumbent. So the Fed's more than likely, unless there's something really they got to make a move, they're not going to.
I mean, inflation's coming down.
Yeah,
jobs are still up, though. I mean, I never thought we'd be wishing for more job loss, but
yeah, right?
it's a weird dynamic where it feels like the better the economy does, the less likely we're going to see rates come down.
Yeah, yeah. So it's and you're absolutely right. So a lot of the gurus out there, and they're probably right, don't see much in the way of cutting until after the election, and really even out into April of 25, May of 25.
Well, it's good perspective. I mean, we're on this yellow brick road together. Yeah. We all want to be in the Emerald City. You yourself, I would say, are one of the luminaries I respect the most. I appreciate you, the man behind the curtain, our wizard, perhaps, the all-seeing eye.
Oh, that's me.
So now I have to ask you one final question. Okay. You're not too far off that silver tsunami yourself.
Yeah.
Where are your plans? Where do you think life will take you and Mona in the next journey?
Yeah, we've been. She wants a farm.
Really?
Yeah, she
interesting.
Does. And you can't.
That sounds like a lot of work for you, Kurt.
I know. I mean, she wants a horse or horses and chickens and to grow stuff, and I mean that's kind of attractive. It's just like, okay, but where and when? And we got time. We're not like ready to rush out and do that.
Yeah,
and I've
sure.
still got runway with doing what I'm doing. My son's 16, my daughter's 20, so I'm in no. And plus, I love doing what I do. I mean, I'm not like ready to give this all up and be a farmer. I mean, I'm not ready for that. But I like I said, I really enjoy what I do. This is a fun career, and it plays well with the way I think. It's I'm, like my wife, I'm always reading, economic books and everything. She goes, do you ever stop working? I said, well, this isn't work.
Yeah.
To me, this is interesting. It drives me crazy if I don't know what's going on. If I was retired, I would still read about economics. To me, it's fascinating.
Well, and your clients are a storybook in the making,
Sure.
right? Chapter by chapter, and you
Yep.
want to, conclude with this amazing journey that you've built incredible wealth, and hopefully kept as much of that for distribution to, to family members and otherwise.
Yeah.
And I think that is that is the yellow brick road that we all want to be on. And so we're thankful to have you on the show, and also to collect your insights. For the rest of our audience, we'll see you next time on Market Perspectives. Thank you, Kurt Owen, UBS Wealth Management.
Thanks, Dean.
Feel free to offer comments and follow us on social media. Until then, see you out there.